He's our guest on this edition of Market Makers, and in case you've just tuned in, thank you for watching this edition of Market Makers. The key variable factor for the market this year has been that how the pendulum of market sentiment for mid and small cap stocks has taken a complete 180-degree swing. When we started the year, it was all about it was this carnival feeling which investors and traders were enjoying when it comes to mid-cap investing. Everybody had become a silent hero, so to speak, based on 2017 performance. But my guest on the show today is someone who has been writing and maintaining consistently from the second half of 2017 that watch your back if you're a mid-cap investor, because the mid-cap stocks were trading way above their fair P/stroke valuation estimates. So now that we have seen what could be called as a tsunami and a virtual meltdown in mid and small cap stocks, is it time to get greedy when rest of the mid cap stocks, when rest of the investors are throwing away some of these mid cap stocks? So Samit Vartak joins us, and I would like to introduce him as the man who got the mid cap space right. So thank you for joining us.
My pleasure.
That's how I would like to classify mid cap stocks. Shaky.
Right. Right. So, you look at the scenario 6 months back, because at that time, numbers don't lie. You look at the numbers and they were so stark, they were so divergent. I had shown in my newsletter, in the, the year-ending newsletter, that for the year 2017, if you just break down the BSE 500 from the top 100 to the bottom 100, the top 100 had given a return of just 30%. Whereas the bottom 100 had given a returns of 135%. Whereas the earnings growth was just 13% for that bottom 100. So it can't go on for too long. And again, if you had to compare the valuations of those bottom 100 companies against, say, the bottom 100 of 2007, the mid cap had reached a valuation of 20 times. Whereas in December 17, the valuation had gone to almost 30 times. So 50% premium to what they had reached in the peak of 2007.
Why did that happen?
It's just liquidity. I think the liquidity has been so mind-boggling, and that's the nature of the equities market. People follow the herd. People follow momentum. People follow the performance, and the performance was so high. Some of the fund managers were, delivering. When I spoke to investors during that time, and they asked me, what is your return expectations? And if I said 20 to 25% over the long horizon, people would laugh at me, because they had made 30-40% returns with not too much of efforts. And it's very easy to start believing that it's normal, it's the new normal for the markets. But 20 to 25% returns are really good returns over the long run. And that's what my point has been, that when there is a huge bull market, and if you have new investors who have never really experienced the big cracks, I mean, this is a crack which is really normal, but if you had experienced the 2007-8 crack or the 1999 crack, you have very different learnings. But if you just live through a raging bull market, your learnings are very different. You tend to think that what you did enabled you for the returns, whereas you would see that each and every strategy works. You don't know whether it was the right strategy or not.
So don't confuse brains with a bull market. 2017 was a euphoric market, largely unleashed on the legs of liquidity. That has turned.
Exactly. Because in a bull market, the returns generally come from the re-rating of the valuations. The re-rating happened 3 to 4x without really change in the fundamentals.
Okay. So is the darkest dust getting over? There is scope for mid and small cap stocks to revive now, but this is going to be a long night and a big winter?
I feel that compared to 6 months back, this is an environment which I really prefer, because you imagine, today people are worried about anything and everything. I talk to the most sophisticated investors, and most of them are worried. I haven't spoken to a single investor in the last couple of months who is positive about the Indian markets. There is pessimism all around, and that's an environment generally which is really good for investors to come in. I mean, imagine last 2 quarters have been few of the best quarters of earnings growth in the last 6 years, I would say, and especially for good quality companies. So the earnings have grown by almost 20% annualized in the last 6 months, whereas the valuations have corrected by anywhere from 25 to 30%, and especially for the mid cap, the good quality mid caps.
Are these fair levels for mid cap stocks, and mid cap stocks are still expensive? Because when you said that they overshot, they overshot not by 10%, they overshot by 30, 40, 50, even 100%.
Right.
So on an average, do you think these are good times to buy, or you would say that the correction will be much more deeper? Yes, I buy a fundamental thesis that stocks are, they become better, but have they reached a bargain level yet?
So the good thing about this correction has been it's been indiscriminate. That good quality as well as bad quality companies have been indiscriminately hit. What happened in 2007 was, if you separate out the bad quality companies versus the good quality, and when I say bad quality, meaning companies who did not generate cash flow and companies who generated the best cash flow, the bad quality companies corrected by 90% at that point in time, whereas the good quality companies corrected only by 50%. And today, there are many companies who have corrected by, the median fall for the BSC 500 or the top 1000 companies has been about 37%. So many companies here have fallen by more than 50%. But I think again, the good quality companies have also corrected by 25 to 30%. I believe there is a huge value which has been created there. Whereas the bad quality companies, if you paint them also with the same brush, I think there is much more pain left in them, because they have gone up by 3, 4, 5 times. So 30, 40% correction is not much for them. I think there is much more left in those companies. But this is a good opportunity for investors who are probably stuck in those companies to get out of those and get into the good quality companies, because such opportunities do not come too often. And again, I think people will make the same mistake, that they will go after momentum, they will go after the herd mentality and try to hide themselves in the large caps, and then the new momentum stocks, where they are hitting 52-week highs. This is the time to think away from the herd, and that's where you will separate out from the herd.
I'll get into what you're doing and where you think there's value in the market, but a classic compounder for for Indian market has been HDFC Bank.
Right.
You may call it overowned stock. You may like to call it a stock which has enjoyed strong P multiples and strong price to book ratios.
Yes.
That bank has never given you bad news.
Right.
So here's one stock which has been a classic compounder despite giving you bad news, despite being a consensus buy. And whereas for those who try to buy PSU banks or corporate banks at every cheeky fall and have trying to time cycles, they've not made money. Right. So how does this theory work? I buy your argument that you should not chase cherry consensus.
Sure.
You should go against overowned stocks. But
Right.
HDFC Bank or in Bajaj Finance, they defied the logic.
Right. I mean, you are right. You will never go wrong in the HDFC Bank or Bajaj Finance. Question is, what are your targeted returns? If your targeted returns are 15-20%, it's best to hide in such stocks. Because there's no need for you to take extra risk. If such companies are going to give you consistently 15 to 20% return, and 15 to 20% return is not bad. It's pretty good compared to the other
You're talking
asset
about
classes.
stock market returns, not earning returns.
Right.
Okay.
Yeah, I'm talking about stock market returns. Question is, I think such opportunities give you, the potential to make much higher returns. There are companies which are growing at 30% plus today, and which are available at less than 17, 18 times multiple, and this current year's multiple. So I feel their fair value is much higher.
Do you own private banks? Do you own consumer names? Do you own staples in your portfolio?
I do not own. I used to own many of those, but for me, valuation is extremely important, and I don't find value in those stocks.
So have your top 3 holdings or top 5 holdings changed in the last 6 months because of this fall?
No, it hasn't actually. I just added to the same names, because the most of those companies have delivered at least in the last.
Mid-cap pullback. Samit Vartak speaking exclusively with us. Of course, you can catch that entire interview over the weekend as well.